Hi, I'm Laurie L. Frank with West End Advisory Group. Welcome to our Financial Literacy Series for 2025. In today's webinar, we'll discuss asset classes such as stocks, bonds, and money market funds, as well as the benefits of balancing your portfolio. At West End Advisory Group, we have a plan-first approach to investing because we believe knowing how much money you need and when you will need it are important factors in your investment success. Joining us today is the owner of West End Advisory Group, Joe Roddy. Joe is a certified financial planner and has been in the industry for over 30 years. Today's webinar is being recorded and will be available for viewing on our website, westendadvisorygroup.com. If you have questions during today's presentation, please use the raise hand button in your webinar controls and we will unmute you. Now I'll turn it over to our host, Joe Roddy.
Thanks, Laurie. Thanks everyone for joining today. I'm going to jump right into today's seminar. Before we get started on it, though, let me share my screen. Hopefully, Laurie, can you see that? Am I sharing my screen now?
Yes, I see the screen.
Thank you. Before we start on today's seminar, I want to remind everyone that this is the third of 3 seminars. Our first one was how much should I save? And that was really designed for somebody who's in their career and they're trying to figure out how much do they need to put away for retirement. Here, we'll give you the Cliff Notes version of that seminar. The answer was that folks who retire, generally, national average is they need 80% of their pre-retirement income. And kind of a rule of thumb that we in the financial industry, investment and financial planning industry use is that if you can save 10% of your lifetime savings, that's from the time you start your work all the way till the end, you should be able to go ahead and accumulate enough money to achieve that 80% of your pre-retirement expenses. The second of our seminar was where should I save it? And the crux of that seminar was trying to identify the differences between a Roth, traditional, and investments that you might not own inside of a retirement plan. Roth being money put away after tax, growing tax-free, and then when you pull the money out, it's income tax-free. Whereas the traditional IRAs or 401ks, money goes in pre-tax, grows tax deferred, and when you pull it out, you pay tax on it then. And of course, there are no tax advantages associated with investments that you own outright. We compared and contrasted those various the differences, advantages, and disadvantages of those type of investments in our second seminar. What we want to do is make sure that we're all on the same page. We're going to be talking about mutual funds or ETFs today. And the reason we're doing that is you have immediate diversification. When you're investing, there are lots of different types of risks. You have inflation risk. You have, if you have all of your money in one investment and that investment were to go bankrupt, something like what happened to Enron years ago, you could lose everything. Mutual funds, however, are ETFs, are where you make a single investment, and that single investment literally invest in dozens of different bonds or stocks, and you have immediate diversification. By doing it that way, you avoid some of the financial risk in that all of the companies inside the mutual funds aren't going to go bankrupt. All the bonds aren't. The risk you have is what they refer to as systemic risk or cyclical risk, where the economy is down, this whole stock market is down. And so today we're going to be talking about mutual funds, but we're going to be, which is what we typically use, mutual funds or ETFs to invest in. However, today we're going to be using examples of individual stocks and bonds. So I think that'll make myself a little clearer in a second. So these are our 3 primary tools: financial investments, money market funds, bonds, and stocks. You can buy all of those with inside of an ETF or a mutual fund. It's just that each of these primary tools are designed to do different things. And once we understand that investments are tools designed to do different things, suddenly I think the light bulb goes off when we start realizing that how to use these tools. So let's start off and talk about the first of these. There we go. Money market funds. Um, when you invest in a money market fund, you're in essence loaning money to major corporations or the federal government. And the terms of those loans are very special. When you stick money in a money market fund, it's designed not to go down in value. So, and to do that, when you to explain that further, when you invest in a money market fund, if you sent the money in today, you would know that tomorrow you could call them up and have your money sent out, and it will not have gone down in value. The interest rate that money market funds pay, however, change ever so slightly every day. So as the interest rates go up or down, you're going to see that the money market funds interest rates go up and down, but the value is designed not to go down. So it's if you, as an example, um, when you're investing in a money market fund, because it doesn't go down in value, the people issuing those investments don't have to pay you very much because everybody loves investments that don't go down in value. So if you're going to invest in a money market fund over long periods of time, you're only going to get back roughly the inflation rate. And there's a whole lot of mathematics that is behind that to assure that that happens. But that is the downside of having money in a money market fund. We'll talk a little bit about what that tool is designed to do in a little bit. The second tool that we want to talk about are bonds. When you're investing in bonds, again, you're loaning money to major corporations or the federal government. Usually, today is a little different, today's market environment, but most of the time, bonds will pay you actually a little higher rate of interest than what the money market funds are. But the terms of the loan are that it's a longer period of time. When you invest in a money market fund, you can get it out the next day. When you invest in a bond, let's walk through and give an example of why a bond, the terms are different, how the terms are longer and how they're different. An example that I always use is Anheuser-Busch here in St. Louis. If they wanted to build a brewery and they wanted to borrow some money, they might go out and borrow 30-year bonds. They would agree to in our example, we'll say pay 5% for those bonds. And for the next 30 years, Anheuser-Busch would pay 5% on a bond. And then at the end of the 30 years, you would get your money back. However, if you wanted your money back before the 30 years, you would have to sell that bond. And if you sold that bond, it would what you would get would be dependent upon what the prevailing interest rates were. If the interest rates had gone down for 5% to 4%, mathematically, there's a way to adjust the price, but nobody would want to pay the same amount for the bond that's paying 4% when it was previously paying 5%. So when interest rates go up, the value of the bonds go down. And when interest rates go down, the value of the bonds go up. So the bonds will fluctuate in value. And if you remember the money market fund, we were lending money in the money market fund, but the values weren't changing, but the interest rate was changing. Every day, if you own a bond, the value of the bond changes, but the interest rate remains the same throughout the whole period of time. So that is the difference between the bonds and the stocks. Again, bonds usually pay higher levels of interest for longer periods of time. The third asset class or tool that we're going to talk about today is stocks. And to give you a sense, bonds today, high quality bonds are paying about 5%. And the S&P 500, the 500 largest companies in the country, are only paying dividends of about 1 to 1.5% on average. So when you're buying stocks, you're buying ownership. And when you buy the ownership, the owner of those companies want to share, they are going to share the profitability of that company, and they share that in a form of dividends. So as the company makes money, they pay a dividend. Currently, the dividends are much lower than what the interest rate is on the bond. So the dividend rate, as we said, for the S&P 500 now is about 1 to 1.5%. That might lead you to the question of why would you want to buy a stock if they're only paying 1.5% and bonds are paying so much more? Well, The companies that own the companies are not sharing all of their money. They are keeping some of it. And they call that, when they don't pay it out in the form of a dividend, retained earnings. And as the company will retain the earnings, and we'll go back to our example of Anheuser-Busch, if they were going to keep their money, and they might keep it to buy another building, buy another brewery, build the brewery, pay off the bonds of the brewery, or even buy stock back from the owners. And as they build a new brewery, as they sell more beer, as there's fewer shares outstanding, the money that they make goes up, and the dividends that they pay go up. And as the dividends they pay go up, then the value of the stock goes up. And so you have the opportunity of not only receiving dividends, but capital gains or capital appreciation. Over long periods of time, stocks are going to be the most, they're going to fluctuate the most in value. However, you're going to end up making quite a bit more over long periods of time. So as we take a look at those and give you a sense of what's happened, you can start seeing, this is a 20-year projection here, and you can see that 20 years ago, if you've invested $10,000 in the money market fund, that's your cash there, it would have grown to $13,000, roughly the rate of inflation. You can see that it's a nice smooth line, so we don't have any big fluctuations in value. On the other hand, you have bonds. Bonds does have some fluctuation values. They did a little bit better over that period of time. They made $18,000. And the stocks has had the most fluctuations. You can see here at one period of time for a few years, it was actually negative, so you would have lost money. And then you had, but over that whole 20-year period, you made over $55,000 if you would have invested in stocks. So if we begin thinking about that, what are these tools and what do we do and how are they designed? What problems are they used to solve? And cash has relatively low rates of return, stable values, and that is used for your emergency money. If you think you're going to lose a job, if you're worried about your house, the roof on your house falling apart, that is money that you want to keep for emergencies. And the reason we want to do that is we don't want to have all of our money in the stock market. And I'm sure you've all heard this before, that you want to buy low and sell high. And what we want to avoid doing is we wanted to avoid that when you're at some low spot here in the stock market while it's down, that we have to sell stocks while they're down, and to buy groceries or to fix a roof or repair a car or feed ourselves until we find a new job. So cash, our money market funds, are tools that are designed for emergency money. Textbook case in financial planning is that you should keep 3 to 6 months of your living expenses in something that you can get at relatively quickly that has stable value. Bonds, on the other hand, they fluctuate in value. If you recall, they have typically pay a much higher interest rate than what the dividend rate is. So their income is predictable. While you're working, you have predictable income in the form of a paycheck. When you retire, you no longer have your paycheck. So bonds are a wonderful source of predictable high level of income. And so people, as they approach retirement, typically will invest more in the bonds because they need to live off of the bonds for the income off of the bonds, and they don't want to be dependent upon selling stocks to go ahead and provide for groceries. Stocks, as you can see from the chart again, provide the highest rate of return over long periods of time, but they have the greatest level of fluctuation. Stocks are typically the best investment if you have a very long term horizon for your investing, and they're a wonderful hedge against inflation. On a year-to-year basis, bonds will typically outperform the money market fund by 1% or 2%, and stocks will outperform bonds by several percent as well. So stocks are long-term investments, lots of volatility, and good hedges against inflation. Here we kind of sum it up here. Money market funds are emergency money, bonds are for income replacement, and stocks are long-term growth. One thing we thought we would kind of do here is to create a couple sample portfolios to give you an idea of how these things might be paired. Somebody who's perhaps retired and they're looking to begin taking income off of their portfolio. You can get an idea of what a 70% bond portfolio with 30% stocks over the last, I think it's since 99 years, going all the way back to 1926. The best year of a portfolio like that would have been up 29%. The worst year would have been down 14.5%. The average rate of return was 7%. And you can see with that portfolio, you had where the portfolio at the end of the year was down 17 out of 97 years. So less than 1 out of 5 years, you would have had a down portfolio. On the other hand, if we flip that around, this might be appropriate for somebody who's retired and is pulling money off. If we flip that portfolio around and looked at what a portfolio might look like for a younger person who perhaps is in mid-career and has 20 or 30 years left before they retire. In their case, they might have 70% stocks and just 30% bonds. You can see that their best year was up 41%. Worst year was down 30%. The average return beat the previous portfolio by a full 2%. It was 9% versus 7%. And under this scenario, you've had 22 years at the end of the year where you would have lost out of 97. And that gives you an idea of how various levels of portfolios might have performed. One of the things that we talk a lot about, and Laurie announced it when we at the very beginning, is that we have a plan first approach to investing, because we like to know how much money you need and when you need it, because we believe knowing that is going to be the chief determinant in how you design a portfolio. If you think that you're going to have large money needs in a relatively short period of time, we're going to want to go ahead and make sure that we protect against that and have money set aside either in high income, high portion of bonds, or money in set aside for emergencies in your money market fund. If you have longer periods of time or your cash flow requirements are lower, then we're going to be looking to have a more aggressive portfolio that's invested in stocks, because we feel that there's not as much need. But in order to determine that, we usually look at your other sources of income, whether it's your salary or Social Security or pensions, and how much money you have available and what you're expending and what the difference is between your income and your expenses and what that gap is. So that gives you a little idea of how we handle investments, build portfolios, and the importance of figuring out year by year what we think your cash requirements are. So at this point, I'm going to go ahead and stop that and stop sharing and see if there's any questions by any of our attendees. Laurie, do you see any questions?
I do not, but if anyone has a question, please use the raise hand button in your seminar controls.
If that is it, then I see no hands raised. Thank you very much for attending. I hope this brief introduction into building portfolios were helpful. We certainly appreciate your time and look forward to talking to you all in the future. Thank you.